I'm going to go real quick on this one because this kind of goes back a couple years on 2004 where the leverage levels were, and then going over to 2007, and you can see that because of the low cost of capital and the high leverage levels, value increased probably 35 to 40%. And what we saw in 2008 and 9 was that values going down by that 35 to 40%. I think across the board in the last, at least in the last 5 months, values have probably gone back up another 20%. I think in markets like DC, they're probably back to where they were in 2007. I think in small tertiary markets, they're probably still down 35 to 40%, depending on the availability of capital, which drives value in large part. This shows the maturing debt, and you've got, when I say all about the banks, you've got, $1.5 trillion of debt that's maturing over the next 3 years. Now, to put things in perspective, I think that this year we'll have about, if you exclude the banks, you say, well, you got the life companies, you got the agencies, you got these new money sources that are in the market. I think in total, best opportunity would be they could put out maybe $100 billion a year. So over the next 3 years, you got $300 billion if everything works well and that CMBS market kind of comes back a little bit. You can put $300 billion. Well, you got $1.5 trillion maturing, so a $1.2 trillion shortfall over the next 3 years. So something needs to happen. Either the banks will start lending a little longer term to solve the problem. There'll be some magic money source that comes in and starts lending. You get foreclosures into the marketplace, and the buyers don't utilize debt. Something has to happen. And that's kind of what I'm waiting to hear what Steve has to say, which will be interesting. I'm not pulling any punches. I'm just, I just can't wait to hear what you have to say. Okay, so how and why are loans being restructured? And it obviously depends on who we're talking about. So we have, you have the life insurance companies, which really don't have a lot of problems in the scope of things, and frankly, they don't mind foreclosing and taking back assets. They own assets, and that is not the issue at all. You have the special servicers, and we're doing a ton of business with special servicers, and then there's the banks. Those are the two groups that we need to talk about when we're talking about, we got a problem, what do we do? The first thing is you got to start talking to the lenders well in excess, of the problem occurring. So, I'm talking about 2 years, 3 years in advance, because one of the big problems you have in the market today is you have loans that are performing. It's just that the value is significantly below the outstanding debt. So it can service the debt service, but the owner is not incentivized at all to put any good money into the property because, frankly, the property's not worth the debt. And so, at that point, we really need to be able to go into the lenders saying, we have an issue. I'm going to be continuing to pay, but I'm not dumb. I'm not going to go ahead and put my good money into this asset when it's worth less than the debt because they got a loan coming due in 2 years or 1 year or 3 years, and I need a lot more time. I need to know that the money I'm putting in is smart money, whether it be my own money or I'm a fiduciary to somebody else. And again, it also assumes, non-recourse versus recourse. From the bank standpoint, when they got a recourse, they're going to look at the sponsor and say, what else do you got? A lot of the business that we do is non-recourse debt, and the strategy is significantly different. I think in all cases, though, the lenders are going to work with the good guys. And so if they think that you're someone they want to have a long-standing relationship with, they think you're acting and performing the way they would like you to act, they're going to work with you. They're going to work with you, and you know what? That's really what needs to happen. So it's not the fault of the banks or anybody else to be extending these loans. They have to. There's no one to take them out. And so, if they took the hard approach and said we're going to start foreclosing all this stuff if they can't pay it, there's no debt. It would be a disaster, and it would flood the market, and it would be a mistake. So, what's happening is happening for a reason, because it's really the only option out there right now. Okay, who are the lenders? There's lots of different lenders right now. Again, it's all about the banks. I keep saying it's all about the banks because they have the most money. But there is life insurance companies and pension funds, and it's super aggressive. It's the least expensive money I've seen since I've been in the business, but it's been the least expensive money since, I don't know, the last 50 years. I mean, when you can get 5-year fixed rate money on low leverage transactions at, low leverage transactions at, 3.5%. So 3.5% fixed IO. I mean, you can afford to, pay up and get low, initial returns on properties that you're buying. So we're seeing the German banks come into the market in a big way. They're making LIBOR floater loans where you can borrow at what is essentially on a floater 2% today. No floors, no caps, very small fees. Really good lenders and can do some big deals. So that is a source that is becoming more prevalent right now. Obviously, you have the domestic banks, and I guess I should have put Amegy in here since you were down here, but yeah. I'll add that to the list after we hear what you have to say. So, but I will say J.P. Morgan, B of A, and Wells are all lending, and they have different buckets of money. The agencies, we'll see what happens over the next year or so there. Private equity funds, with these new money sources, a little bit higher priced, trying to take advantage of voids in the market, having a hard time getting the money out right now. There's really not a capital crisis. It's really a good product crisis. You have the REITs, the equity funds, and some of these other groups are all new sources of money trying to play, little higher yields, maybe do some different type of product. And then you have CMBS, which is what could get this engine moving again. And so if you take a look at the lending market, you really had this engine that was cranking. And the CMBS market was lending $250 billion a year, and the banks knew that. So the banks were making these loans because they knew that the CMBS lenders were going to take them out. So it's just this big machine going. Well, CMBS stops, you got $250 billion a year that everyone was expecting to be invested, and instead you have nothing. And so that's why the banks ended up kind of holding a lot more of this product than they might have otherwise held on to. But CMBS is coming back. It's not as robust as I think people would like it to be. They're much smarter. They're not going to make the mistakes. And I think we're still interested to see if there's going to be some risk sharing, which I personally think there needs to be in order to align interests. And that was one of the big problems that we had on the CMBS market, was an unalignment of interest. But if they're actually holding parts of all the tranches of debt, they're going to be much more inclined to make a little bit better loans. I think in the past the MO has been, we're really not lenders, and they weren't lenders. We're conduits. If we can make a loan and we can sell it into the marketplace quickly and make money on it, we're going to do the deal. And so there was deals done where the CMBS lenders, not a good sponsor, not a good location, not a good product, nothing's good, but they can make money on it, so they're going to go ahead and do that transaction. Those deals aren't going to get done anymore.